All right, good afternoon, everyone. Appreciate you being here this afternoon, joining us for another webinar with the Reliance Financial Partners family. Going to give everybody around 30 seconds to a minute to join here. I know we had a bunch of you in the waiting room over the last 15, 20 minutes. Really appreciate you taking time out of your busy week to join us for one of these. All right, looks like people are starting to continue to file in. I think we had over 300 Reliance clients registered for this session, so really excited about the opportunity to share some information today. But we're going to go and get right in, just in the, respect everybody's time. Today, we're going to have a very short session on what the One Big Beautiful Bill means to you in your retirement. There is a lot of information out there associated with this. The phrase I like to use is like you could get Google slapped like really quickly if you're trying to Google specific things related to it. So we're just going to focus on some of the key items that we believe are most important to share to retirees. We don't anticipate this session going over 30 minutes today, so we're going to keep it real short and sweet so you can get back to your day. But before we get into it, one thing we really want to make clear, this is something we share on all of our presentations, is today is about information only and not specific advice. For us as fiduciaries, to give you specific advice, especially if you're not a client of Reliance Financial Partners, we need to have a full understanding of your specific situation to be able to do that. Today is about information only. At the end of the presentation, we will also offer the opportunity for you to engage and chat with our team. If you're not a member of our client family, or if you're a client and you have questions for your advisor, we're happy to field those as well. Before we jump in, like I said, we've been doing these presentations on a monthly basis. If you want to view any of the previous sessions that we have held, they are all live on our YouTube channel, youtube.com/Reliance Financial Partners. They're also all on our website as well. Two of the most recent ones we held that we got very positive feedback on were navigating market volatility and tax pitfalls in retirement. Again, you can check those out on our website or go directly to our YouTube channel. But before I pass the baton over to today's presenter, Grace Succi, a financial advisor here at Reliance, just want to share a little background information about her career if you haven't had the opportunity to sit down, meet, or have a conversation with her. She has 30 years experience spanning multiple financial service companies and elder law. She's got deep, well-rounded perspective from her time at TD Bank, JP Morgan Chase, and most recently, Hurley Elder Care Law before joining Reliance Financial Partners, where she helps many of our clients navigate uncertainty in retirement with clarity and confidence. And she is excited to be back for our fourth live webinar this year on the One Big Beautiful Bill. So I'm going to pass it over to Grace. She's giving me the signal that she's ready to go.
All right. Thank you so much, Zach. So before I get started, I just wanted to remind anybody that maybe isn't familiar with us. We are Reliance Financial Partners. The business was founded in 2012. We are independent financial professionals, which means that we are beholden to you, our clients, as fiduciaries. And this is just a snapshot of our team who come to work every day excited to serve you. But let's kind of talk about what we're going to go over today. So, of course, we're going to be talking about the One Big Beautiful Bill, or the OBBB. And while we can't cover all of it because it's very long, we're going to go over some key points such as what's changed, what can impact you, and what does it really mean for retirees. So it's going to be focused in that arena. So had the bill not passed, 62% of people would have faced higher taxes, and you could have experienced a 7.5% overall tax increase. So this is showing the current income tax brackets. As you can see, individuals and married filing jointly here, and the differences between them. And one thing that I talk about a lot is when we're doing planning is kind of the hidden hit that people face when they go from married filing jointly to single or individual. And that's something that we like to plan for through tax planning. But one of the biggest changes is that the standard deduction was permanently increased effective 2025, and it will be adjusted annually for inflation. So the new or standard deduction level is $15,750 a year for single filers, $31,500 for married couples filing jointly. And this creates a great baseline for taxpayers to give them some instant deductions if they don't it eliminates the need for many people to itemize. Another great thing that came out this year is an additional senior bonus deduction. So what they're going to do is give an additional $6,000 deduction for those who are over the age of 65. This is a temporary thing. Currently, it's effective 2025 through 2028. There is an income phase out as well. And the nice thing about it is it's a universal application, which means it applies whether or not you're itemizing or taking the standard deduction. So this was kind of the little kind of caveat that was thrown in there, that they did not eliminate taxes from Social Security. However, this is going to help seniors save money. It was kind of like the exchange there. And we're going to see that in action in our next slide. So if we look at these examples here in our 2024 numbers versus our 2025 numbers, over here on the left, you can see with the higher annual standard deduction plus the existing 65 plus deduction of $2,000, which is still received. In addition to that, you get that additional 6,000. My person on the left here got an additional 7,200 in deductions this year. Even more powerful for a married couple, if you kind of look at how that plays out, you've got your 31,500 plus your additional 1,600 each. And then your $12,000, 6,000 each senior deduction. That's a difference of 14,400. So this could be very, very impactful when you're doing your taxes. Let's take a further look into this and just look at a real couple in a real scenario here. So in my example here, married couple has earnings of 100,000. They're getting their deduction, standard deduction, less their 65 plus deduction, less their senior bonus deduction. And this takes their taxable income from 100,000 to 53,300. This is huge. This gives a lot of opportunity for additional planning. This could put you in a scenario where you may be able to enjoy some zero cost capital gains. So it is important through planning for us to take advantage of this while it is in existence and try to maximize the tax savings as you go along. So it's pretty exciting. My chart here kind of shows you a nice visual as far as like what this looks like, for seniors age 65 plus under the big beautiful bill. So you've got your single deduction here. In the middle, I thought it was important to illustrate what it would look like if only one spouse was over 65. You see, you're still getting your senior deduction and you're getting your bonus as well. And then, of course, you get the most savings as a married couple in the example over on the right. One other change that occurred was the estate tax exemption was made permanent. So currently, the estate and gift tax exemption is 13.99 million for individuals, 27.98 million for married couples. In 2026, that's going to be increased to 15 million and 30 million for married couples. And these numbers will increase with inflation as well. So this is important for, inheritance. There may be some of you out there that are doing the annual gifts of 19,000 a year, and to help, kind of reduce the estate tax burden. And that's just to know that this is kind of where you're starting, basically. So, If you're giving $50,000, to your children, that might not necessarily mean that it's going to be taxable if it's within these limits. Another permanent provision is the alternative minimum tax was giving the limit was given a permanent extension. And so this makes permanent the higher AMT exemption amounts and income thresholds that were put in place in 2017. And all that this means is that, you know, they won't fall back to lower levels that, were in place prior. And that just helps shield more taxpayers from getting hit with the alternative minimum tax. Another nice feature is the charitable deduction tax break for non-itemizers. So this is starting in 2026. So it's a permanent provision that allows taxpayers to claim charitable deductions of $1,000 for single, $2,000 for married couples filing jointly, whether or not they itemize. So this provides some incentive for charitable giving. And, the key thing here is that it is in place whether or not the standard deduction is taken. But don't forget, there are other ways to make charitable donations and save money on taxes. You can do what's called a qualified charitable distribution, or a QCD. If you're over 70 and a half, that means you take money directly from your IRA and you send it directly to the charity, so it never touches your hands. And this is deducted from your income as if you never received it, basically. So that's a great way to make charitable donations as well. And that is something that we here in the office will assist you with. So if you are a client and you are giving money to charity on a regular basis, or if you are charitable or want to donate, there was a lot of people who have contacted us wanting to make, flood donations, which is wonderful. We can certainly help you do that through a QCD. So please don't delay and let us know if you want our help with that. The other thing you can do is you can do a gift of appreciated stock. So let's say you bought a share of Apple, at $50 and now it's worth, $400. You can actually gift that stock to a 501c3 organization. And when they redeem that stock, they're a tax-free organization. So it's a way to give away, a highly appreciated asset, and save money on taxes as well. So these things are out there. I want you all to know, and we absolutely can help you with that. Another deduction is the state and local tax deduction, which for some people here in Texas, with us having, pretty high property tax rates, this is a pretty cool exemption. So that was raised from $10,000 to $40,000 in 2025. It does have a phase out. So if you have over, $500,000 in income, this may not apply to you. And it's also going to receive annual growth. So it increases 1% annually through 2029. So this is another nice thing that they've implemented. All right. I know everyone loves their grandchildren and their children. So the Trump savings account, the tax advantage savings account that is being rolled out, essentially, these are special accounts designed for children born between January 1, 25 and January 1, 29. So if you're expecting a new grandbaby, definitely we need to be talking about this. So you could put up to $5,000 per child into an account that will grow tax-free. It must be invested in a diversified index fund. And if you do this, the government will kick in a one-time $1,000 contribution. So what happens, the idea behind it is, let's let this account grow and grow and grow. And then when the child turns 18, it actually automatically converts into a traditional IRA for them. And they can use that, for certain purposes. There are early withdrawals that you can make for things such as paying for education, starting a business, or purchasing your first home. So, nice feature there. And then there's no tax on auto loan interest. So from 25 to 28, there's a new deduction for interest paid on loans for new vehicles that are assembled in the US. That deduction is capped at $10,000 a year, and it also has a phase out. So it begins to phase out for single filers earning over 100,000 and married couples earning over 200,000. But like the senior bonus, this deduction is available whether or not you itemize or take the standard deduction. So it's pretty accessible. So time to go get that new car, maybe. So there's always concern about how, we will pay for these deductions, and nobody really knows what's going to happen in the future. Will we reduce future spending? Will we increase borrowing? Will we raise taxes? Is that coming down the pike? I mean, most people I talk to, when I say, do you think taxes are going to go down? Most people say no. So we have to take advantage of these while they're here, and we can absolutely do this with planning. This is a great time to look at Roth conversions. It's a great time to spend some traditional IRA money and have some fun. That's what, you all work so hard for, retirees, is to be able to have fun and enjoy life. And that's something I'm super passionate about helping my clients do. The issue with tax deferred accounts is that every distribution is taxed at your highest rate. Once you reach a certain age, you're going to have to take distributions regardless if you want or need them. And these distributions can lead to higher tax bracket, additional tax on Social Security income, more tax on capital gains, Medicare premiums can be affected, that type of thing. And your tax deferred accounts, when you leave them to your heirs, are the least tax efficient. And so, what I meant by saying that your tax deferred money is taxed at your highest bracket, I'm going to explain here. So let's say that you're single with $200,000 in taxable income and you're not taking an IRA distribution. So you're here in the 32% tax bracket. Well, if I add a $10,000 IRA distribution to your income that you already have, now with our graduated tax scale, that income is going to be taxed at a rate of 32%. So that means the $10,000 that you just took out of your IRA, you're going to pay an additional $3,200 in tax. Oh my God, there goes my light again. This happened to me last time if you guys watched my previous webinar, and it won't turn back on. Okay. I just do that for comic relief, everyone. But we really do need to fix this light. I'm going to talk to Dana about it. But anyway, what I was saying is your $10,000 is taxed at an additional $3,200 tax for you. So that's why tax planning is so important. What can you do to help preserve your retirement savings? If you look at your three tax buckets, right? You've got taxable on the left, which is your taxable income. Then you may have some tax deferred assets, such as your IRAs. And then you have your tax-free assets, such as your Roth IRAs and your life insurance and things of that nature. So through planning, we can help try to shift as much of your income from the left to the right. But again, it's not a one size fits all thing. It has to be carefully done, and everything needs to be considered because you don't want to inadvertently put yourself in a scenario where you're paying more in one area because you're trying to save on the other side. So this is really the basis of our plan on purpose, or our financial plan that we do here for our clients. So yes, of course, we handle your investments, and that's an important part of it. But you don't have a true plan unless you're addressing all of these areas, such as income, healthcare, your legacy plan, and your tax plan, along with investments. All of these things work together to make sure that you can have a fruitful and enjoyment in your retirement. And I really get a lot of joy out of looking at all of these pieces and how they work together and trying to help people figure out ways to make their money last as long as possible for them. So let's talk. Are you a client with a question? Are you working with another advisor? Or are you evaluating? I love to talk to people about this. I love to talk to people about their plans. If you're interested in having a meeting with one of us, Zach is going to send out a link to be able to have us contact you to schedule an appointment. I know I've had a lot of my clients say that they were going to jump on this today. So hello, everybody. Very happy to see you, and hope to see you all in the office very, very soon.
Yep, Grace did a great job. Like she said, we'll send out a link to the replay of this session if you want to reference anything back later this week. Should be out by end of the day tomorrow. But if you have a question, you want to talk to anybody on the team, just go to the website, reliancefinancialpartners.com/contact. You can drop any questions in there, whether you're a client or not. I'm happy to field those. And again, we appreciate Grace taking time out of her busy day to give us some wonderful information. And we look forward to seeing you on the next session sometime in August. So take care. We'll see everybody next time.
Bye.